Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan, good to have you with us here at Ausbiz. So let's check what happened on global markets overnight. A mostly positive session, although heightened geopolitical tensions dampened investor risk appetite. Wall Street's main indices finishing in mixed territory there, with the NASDAQ the pick, and that's after the S&P 500 and NASDAQ hit record highs in the previous session. The focus is on the US labour market this week, with job openings increasing moderately in October. Now, you've got a shot of Tesla there. It did slip after data showed the car maker's sales of China-made electric vehicles fell 4.3% year on year in November. Shares of Zscaler fell after analysts noted that the cybersecurity firm's second quarter revenue forecast failed to impress. US steel fell heavily after Donald Trump reiterated his opposition to Nippon Steel's planned $15 billion purchase of the company. And shares of copper miners, including US listed shares of BHP and Rio, have risen as the price of the red metal touched its highest in almost 2 weeks. And US listed shares of South Korean companies fell after President Yoon Suk Yeol briefly declared martial law in the country in a standoff with Parliament. Well, in fact, President Yoon said he imposed the martial law in order to protect the liberal democracy, saying opposition parties have taken hostage of the parliamentary process. And lawmakers rejected the decree in what is seen as South Korea's biggest political crisis since it became a democracy in 1980. In the US, job openings rose 372,000 to 7.75 million in October, the largest monthly gain since August last year. Meanwhile, Fed Reserve policymakers have said the job market is solid, and they believe inflation is heading down to the US Central Bank's 2% target. Fed Governor Adriana Kugler is saying, "I view the economy as being in a good position," and after making significant progress in recent years towards our dual mandated goals of maximum employment and stable prices. Well, longer dated US Treasury yields rose, with the 10-year up to 4.19%. The 2-year fell close to 5 basis points to 4.15. And the South Korean won tumbled to a 2-year low in response to the country's political crisis. The US dollar index down marginally, the Aussie at 64.8 US cents, and Bitcoin approaching 96,000 US dollars. A quick check of commodities overnight. Oil prices surging on signs the Israel-Hezbollah ceasefire is in danger of collapsing. Oil investors are also positioning for OPEC Plus to announce an extension of supply cuts this week. Brent crude futures almost 2.5% higher at $73 a barrel. Copper up more than 1.5%, iron ore slightly higher at $105 US dollars a tonne. And the gold price pairing gains to be at $2,642 an ounce, as that jobs data hinted at the cautious approach from the Fed in terms of rate cuts. Well, let's get some greater detail on what we're seeing more globally from an investment perspective. Sam Ruiz joining us from Rowe Price. Sam, good to see you.
Good to see you, Andrew.
Last time we spoke was just on the cusp of the US election. Well, we all know how that turned out, didn't we? So it has changed the picture significantly. What are you seeing at the moment? I guess because we still have the Trump trade, that's essentially become the Santa Claus rally. So markets at or near record highs. Is that sustainable, do you think?
I think it's the question everyone's asking at the moment. What's remarkable is we're in 2024 and we have global equities. I'll convert these to Australian dollars. Global equities almost up 30%, the US market almost up 40%. And a little fun fact for you, the US market will be very likely printing more than 20% returns this year for the second consecutive year. That's only happened in 3 other instances all the way back to the 1920s. So the reason I give you that detail is I think people are right to question, this feels too good for too long. Where are we going from here? I would just say that the market is optimistic, as are we, because we have a resilient US economy that has avoided that recession scenario. We've nailed the soft landing, and now with the Republican sweep, we have very easy policy likely to come through, very stimulatory policy that's going to further extend not just the US economy, but in a relative sense be better for the US, which is why the US market, you did emphasise, is reaching new highs at the moment.
Yeah, because we've got those rate cuts coming through, perhaps another one coming this month. And on top of that, the Trump administration and the promise of tax cuts.
Absolutely. Promise of tax cuts, but also And that's an immediate boost for the bottom line of corporates. But we have really that, if you were to boil it all down, that policy that says let's make it easier and more likely that US companies can make more profits from here. So it's not just cuts, it's also the easier regulation environment that we're expecting should do things such as reinvigorate capex. A lot of companies that we've been speaking to have been sitting on their hands, uncertain about whether they want to actually use money in the future. So we do expect things like more M&A. We do think that the industrial economy, which I think it's a really important distinction to make here. The US economy has been very resilient, but the industrial economy has actually been in recession for more than 2 years in the US. So there's some things like that we just expect cyclically are going to reaccelerate, which I would say for investors is really encouraging, because we're coming out of this market that's all been about AI and tech and some of these things to something where more of these real economy companies are likely going to benefit going forward.
Sector-wise, which are most likely to benefit under Trump's policies, do you think?
Yeah, I'll in terms of what will most likely benefit, I'll answer with some of the changes we've been making in our portfolio. So we've actually been adding to US banks, which is one area. US banks benefit from a number of things. Likelihood that interest rates are going to be higher for longer. So great for the economy, we think, this Republican sweep, but probably means inflation isn't going away as fast, which leads to higher rates. The likelihood of recession is probably declining. That's good for banks where people worry about credit. Another thing as well is the regulation on banks, which we think will be easier. They tend to have more pressure on them in terms of how they use their capital and doing that in a less risky way. And we think that that's going to become easier. So allowing them to do things like investing in treasuries with more of the balance sheet, which is better for returns. The other area I've alluded to, we think we're seeing a reacceleration of the industrial economy. So there are areas that these aren't typically sexy companies, but one I'd highlight to you, Old Dominion Freight. What do? They are one of the leading freight forwarders in the US. They basically take a big truck, and in that truck they fill it up with everyone's orders and ship that around the country. That's a great example of a company in an industry that's actually in its worst recession since the GFC, despite the economy being in a relatively healthy spot. So we think Old Dominion Freight, they have some of the best pricing power. Through this weakness, they've actually been increasing capacity so that they can take on more jobs when that reaccelerates. And we think that they're really primed to benefit from more industrial and just general activity with more shipping happening across the US economy.
What about in the steel sector? And once again, we talk about the onshoring that we're likely to see under a Trump administration. What are the benefits there?
Yeah, you mentioned even overnight the blocking of the Nippon steel bid. I think this is a really good example of, we hear about this sort of make America great again, this reshoring, bring things back to US shores. One reason we think that some of these companies, particularly one that we like, is actually a company called Steel Dynamics. What Steel Dynamics benefits from is greater protectionism and tariffs on steel, particularly steel arriving from China, should actually mean that US steel prices remain in a higher zone, because it's less likely that cheaper steel floods their market. And we have a company like Steel Dynamics that can do it quite competitively. So it's electric arc furnace is basically how they're manufacturing the steel. And they have previously spent a lot of capex to put the company in a better position. And what was quite typically cyclical and flooded with cheap steel now just becomes in a less cyclical, higher zone where they're, in our view, just going to print more free cash flow. So a great beneficiary of a US company that benefits from trying to have policy that basically prevents other countries dumping stuff in the US cheaper.
So Sam, you're saying we're likely to see a broadening of that leadership beyond the Mag 7, and of course a lot of that was driven by AI. Should we still be bullish about the AI thematic?
I think that the distinction I'd make here is this isn't the rest of the market's better because AI is bad. I think that there are some fantastic companies in there. The distinction I would make is we have possibly just started to approach the end of that first initial investment cycle, where you've had a few very large companies spending up to $200 billion in aggregate on building out the capacity, the data centers, connecting these data centers to the grid, plugging them in so they actually have the ability to run a lot of AI. And we're at this second phase now, we think, where really more water needs to go under the bridge in terms of who's actually going to use that AI capacity, which, to dumb it down for you, which secondary company is going to say, I'm willing to pay Microsoft, I'm willing to pay Amazon money to use their AI training models to do something for my own products or services. And we don't yet know how much consumers are willing to pay for that. And if companies find out that there's basically not enough return, then we might just see some deflation in that initial AI phase. Big picture though, we think it's an innovation that's going to change our lives, and we will find out over the medium term that it's actually going to be really beneficial for productivity, and there will be some very big winners from this. So bullish AI, near term, you just want to be mindful of how that initial investment cycle might be closer to the end.
Now, Sam, last time you were on, which was just before the election, you were looking for opportunities in emerging markets. Have you switched your approach now as a result?
Yeah, we are very slightly just a little bit more cautious on emerging markets in the near term. There's tariff uncertainty. I would just say the danger here is a lot of emerging markets, even just the way we're framing it, they all get tainted with the same brush. And these countries are in different regions. They have different trade agreements with the US. And we don't yet know until January what types of tariffs will be implemented, whether they'll be done in a blanket approach across all the countries, isolated single countries, and whether it will be fragmented by industry or across all industries. So I think it's prudent for investors to say, while we don't know that, maybe just take a little bit off the table. But where we think that, in contrast to China maybe being disadvantaged, there is a real likelihood that a country like Vietnam actually could be a net beneficiary medium term. If people want to basically take supply chains out of China, Vietnam is really geographically advantaged where they're based, very low wages, and they have really moved up. I would really emphasize this. Vietnam might have been known in the past for textiles and making shoes and t-shirts for Nike, for example, whereas they've really impressively moved up to exporting technology, manufacturing. If you have a pair of Apple AirPods, they're probably made in Vietnam. If you have a Samsung phone, that's probably made in Vietnam. So they could be a really big beneficiary of China manufacturing moving outside.
Sam, always terrific to get a view of your strategy there at Rowe Price. Thanks
Good to be back, Andrew.
Quick check of where we're likely to open locally, and looking for a bit of a negative start on the ASX. SPI futures down around 1/3%. That, of course, is after we did touch another record yesterday. Stay with us. The open is a couple of minutes away.